press the bell icon on the YouTube app and never miss another update.
Let's discuss the concepts of current tax and tax expense. Two extremely simple concepts actually. See, by current tax we mean the tax that is payable in the current year. It's as simple as that. So what is the provision for a tax that we should be recognizing for the current year? That provision for a tax, that is now what is going to be referred as current tax. So all these years we recognize a provision for a tax in our books. Now don't call it as provision for a tax. Instead of provision for a tax, call it as the current tax. Next is, what is tax expense? Okay. Tax expense is the sum total of current tax and the deferred tax. So current tax and the deferred taxes both will be total, and whatever figure that we are getting, we will refer that as the tax expense. When it comes to deferred tax, it can be deferred tax liability or it can be deferred tax asset. Current tax, as we know, is the tax that is payable in the current year. I have to recognize a provision. Remember, it will be debited to the profit and loss account. Your accounting entry will be profit and loss account debit to current tax. So current tax is something that will be debited to profit and loss account. Deferred tax liability, this is also something that will be debited to the profit and loss account. So DTL debited to profit and loss account. However, when you are recognizing DTA, right, the accounting entry for DTL is also profit and loss account debit to DTL. So this is P&L debit to current tax, this is P&L debit to deferred tax liability. But here you will be crediting the profit and loss account. My accounting entry for DTA will be DTA account debit to profit and loss account. So P&L is getting credited over here. Why I am discussing this is that if you have current tax and deferred tax liability, if you have current tax and deferred tax liability, both will be debited to the profit and loss account. Then this total will be positive. If the total of tax expense is positive, we will consider that to be tax expense. Okay. But it's also possible that you have current tax and a deferred tax asset. So instead of a DTL, let's say you are having a DTA. Now current tax will be debited to the P&L, but DTA will be credited to the P&L. So when you take a total of tax expense, the total of tax expense will not necessarily turn out to be positive. It may even turn out to be negative. For example, let us say current tax figure is 10,000 and this deferred tax is actually a DTA of 12,000. Understand this? That means 10,000 will be debited to the P&L, but 12,000 will be credited to the P&L. So when you take a total, when you will say 10,000 plus, now because this 12,000 will get credited, I am writing it as negative. 10,000 will be debited to the P&L. See, my word is expense. Debited to the P&L, so expense is 10,000. But 12,000 will get credited to P&L. Expense don't get credited to P&L. Expenses get debited to the P&L. That is the reason I am writing it as negative. So 10,000 plus negative 12,000, this turns out to be negative 2,000. So the total of tax expense is not positive. The total of tax expense is negative. It is very much possible that the total of tax expense might just turn out to be negative for a simple reason that the deferred tax asset may be higher than the current tax. In case if this was not 12 but 7,000, okay, 7,000, then I will still have a tax expense of 3,000, right? But the DTA is greater than the current tax. In such a situation, when I take a total of tax expense, instead of getting a instead of getting a positive figure, I get a negative figure. So my tax expense is turning out to be negative. If the tax expense is negative, we don't call it as tax expense. We call it as tax savings, right? So when you prepare your P&L, don't call it as tax expense. Say it as tax savings and then make it positive. When you say tax expense, you say tax expense is negative 2000. But the moment I say that no, it is not an expense, but it is a savings, then tax savings will become positive. So we have to call it now as a tax savings. After all, what is the concept of DTA? The concept of deferred tax asset is the amount of tax that you will save in future. That's the reason we will call it as a tax savings. Good. Let's discuss more now. How exactly we are going to work out the same using the tax rate. See, whether you want to calculate current tax or deferred taxes, we require a tax rate. Without the tax rate, we cannot do these calculations. So what tax rate should be applied by us? What are the tax provisions that we should be applying? Let's understand that. Let's first start with the current tax. We know current tax is nothing but the tax that is payable in the current year, isn't it? So let us identify the current year. Let us say the current year is 2020-21. Now I want to know that how much tax I will have to pay for the year 2020-21. So I will have to now apply the tax provisions. I will apply the tax provisions of the assessment year that is applicable to the current year. If the current year is 2020-21, then what will be my assessment year? Right, we are seeing this purely from the viewpoint of income tax now. Your assessment year will be 2021-22. So your current year is 2020-21, which in the terms of income tax will be referred as the previous year, isn't it? So I will call this as the previous year. And for this previous year, this is the assessment year. So whenever you are calculating the current tax, identify the assessment year. Then identify what are the tax provisions that are applicable to that assessment year. And that is what will decide the amount of tax payable in the current year. And the amount of tax payable in the current year, that is nothing but the current tax. So please apply the tax provisions for the applicable assessment year. What income are exempt in the assessment year, what incomes are taxable, what expenses are allowed for deduction, what expenses are disallowed for deduction. And similarly for this assessment year, identify what is the tax rate. So let us say the tax rate is turning out to be 25%. So when you calculate the current tax, apply the tax rate of 25% and find out what is the amount of tax payable. If there is any surcharge, then take 25% and also add the surcharge and then find out what is the current tax. It is also possible that you are a proprietary concern. See, we know that for a proprietary concern, tax is applicable depending upon the different slabs of income. Fine. So apply the assessment year's tax provisions, find out what is the total taxable income, and then as per the slabs of income, whatever is the tax that is payable, that will become your current tax. So it's as simple as this. Find out which is the current year for which tax is to be determined, identify which assessment year is applicable to it, and for those assessment year, whatever tax provisions are there, please apply those tax provisions. Apply the tax rate including the surcharge and cesses and whatever is there, whatever is the final tax rate, identify it and work out the current tax. And once you are ready with the figure of current tax, debit it to profit and loss account. How will I now do the calculation for the deferred taxes? Let's see that. Deferred taxes. This was for the current tax. What to do with the deferred taxes? Now see, if it is a deferred tax liability, that means it is a tax payable in future. Similarly, if it is a deferred tax asset, then it is tax that is going to be saved in future. So here what happens is, if you are aware, this is what AS 22 says, if you are aware about tax provisions already enacted or substantively enacted as on the balance sheet date, then those tax provisions can be considered for the purpose of determination of the deferred tax. This is what it is saying. Let's try to take certain dates and things will become a little bit more clear. Let us say we are preparing our balance sheet on 31st March 20. Okay, that means my current year is 2019-20, which is nothing but also my previous year. Now for this current year, your assessment year will be 2020-21. Okay, so apply the tax provisions of this assessment year. This will help you to find out what is the amount of the current tax. So I'll get the amount of the current tax over here. Now, I want to know how will I calculate my deferred taxes. Now we know that deferred taxes are because of timing differences. Timing differences will reverse themselves in future. Okay, so your year is 2019-20. This deferred tax is based on a timing difference. Okay, we are expecting that this timing difference will reverse, and it will reverse in the year 2020-21. On 31st March 20, there is a timing difference. On that, I am recognizing a deferred tax asset or maybe a deferred tax liability, whatever. Now, we know that this timing difference will reverse, and I am expecting it to reverse in 2020-21. Now, if it will reverse in 2020-21, then that reversal will depend upon the tax provisions of that particular year. So if you are saying it will reverse in 2020-21, that means its assessment year is 2021-22. So please understand, when it comes to current tax, my assessment year is 2020-21. But when it comes to deferred taxes, then my assessment year is 2021-22. Now the important question. Deferred taxes will be measured on 31st March 20. Okay, deferred taxes will be measured on 31st March 20, but this deferred taxes will result into higher taxes, or the deferred taxes will result into lower taxes in the next year. So the question that arises is, on 31st March 20, are we aware about what is going to happen in income tax in future? Do we know that what will happen to the income tax provisions, what will happen to the income tax rates in the assessment year 2021-22? If you say that there are certain tax provisions which are already enacted, I'm using the words already enacted or substantively enacted, when enacted on the balance sheet date 31st March 20, then use those tax provisions to determine your deferred taxes. Now you may wonder that how will these tax provisions be enacted? I'll tell you, a lot many tax provisions might have already got enacted. If you are saying my balance sheet is on 31st March 20, understand one thing. On 1st February 20, the central government must have definitely announced its budget, right? It must have made a budget presentation. So what happens is on 1st February 20, there is a budget. Remember, the tax provisions which are announced in the budget are never for the current year. Those tax provisions are always for the next year. So in the budget speech, right, so we are saying on 1st February 20 there is a budget. Now the budget will be proposals of different tax provisions. Remember, these tax provisions are for the next year. So they are going to be applied in 2020-21, and for that the assessment year will be 2021-22. You can now link this to this discussion that we are doing. So on 1st Feb, the finance minister is presenting the budget. The finance minister is announcing what will be the tax provisions now in the next year. All these tax provisions will be discussed and debated. There are certain tax provisions which we are virtually certain will definitely get enacted. For example, let us say the government is announcing a new tax rate. Now, more or less, it is certain that this tax rate is going to be applicable in the next year. For example, the tax rate right now is 25%, but in the budget, the finance minister is announcing that now the tax rate for companies will no longer be 25%. We are bringing it down to 20%. So everyone knows that this will be the tax rate in the next assessment year. So when you calculate deferred tax, your deferred tax is reversing in 2020-21, for which the assessment year is 2021-22. And the new tax rate is already enacted on the balance sheet date. On the balance sheet date, as an entity, I know that, see, from the next assessment year, my tax rate will reduce. Measure the deferred taxes at the new tax rate if you already know it as on the balance sheet date. So when you calculate current tax, use the existing tax rate of 25%. When you measure deferred taxes, don't use 25%, because for deferred tax, I know I will have to pay extra tax in future, DTL. I know I will save tax in future, DTA, but you will not pay extra tax at 25% anymore. You will not save tax at 20% anymore. 25% anymore. You will save tax, or you will pay tax at the new tax rate, which is 20% announced in the budget. I hope you get my point. Current tax is tax payable for current year. So use current year's assessment year as a base and finalize your tax provision. But when it comes to deferred taxes, you are not bound by the current tax rates. Deferred taxes will reverse in future. So are you already aware what will happen in future? Are you already aware what will happen in future? So if the tax provisions are enacted or substantively enacted, enacted means it is already passed in the parliament, and substantively enacted means more or less it is going to be passed in the parliament. Maybe the parliament is still debating about it, but normally it has been observed that if you are giving some benefits to the corporates, or if you are giving benefits to the general public, normally those provisions will get passed. Normally it has been observed. Even the opposition parties will find it very difficult to oppose anything which is in favor of the public at large. So when such kinds of announcements are made, more or less it is certain that it is going to be ultimately be passed by the parliament. Once it will be passed by the parliament, it will go to the Rajya Sabha, and from the Rajya Sabha it will go to the president, and the president will sign it and it will become an act. But normally, more or less, it is certain that if it is passed by the Lok Sabha, a budget which is passed by Lok Sabha, it is a given. It is assumed that it will definitely get passed by Rajya Sabha as well. And once it goes to the president, I have never seen in my life till now that the president is rejecting any of the provisions of the budget. So more or less it is certain that it is substantively enacted. So if you are aware about the future tax rate, use it and determine the deferred taxes. One more thing. Let us say I am a proprietor and there are different slabs of income. If there are different slabs of income, then how to calculate the deferred taxes? For example, I have one slab of 10%, another slab of 20%, and a third slab of 30%. This is how I pay my tax. Now, when I want to calculate deferred taxes, should I determine my deferred taxes at 10% or 20% or 30%? What AS 22 says is that when you calculate your current tax, find out what is your average tax rate. How will I get my average tax rate? Find out what is the amount of your current tax. Current tax should be divided by your total taxable income. So current tax I divide by total taxable income. Let's say it turns out to be on an average 17%. So is your average tax rate 17%? Then use 17% to calculate the deferred taxes. Otherwise there will be confusion. See, if I have 3 slabs and I have 10%, 20% and 30%, then at which rate should I determine the deferred tax? Find average tax rate. Use the average tax rate and find out what is your deferred taxes. And the final and the most important thing, Whenever you are calculating deferred taxes, we always say that deferred taxes will reverse in future, but that does not mean you discount it. Accounting Standard 22 is clear. Discounting of deferred taxes is not permitted.
Press the bell icon on the YouTube app and never miss another update.